traders, actually, let's just head straight on over to the floor of the CME Group, where we have the CEO of Prosper Trading Academy. He's standing by. It's Scott Bauer. He's joining us this morning. Scott, thanks for starting your week with us here on the TD Ameritrade Network. Good morning. Earlier in the show, we discussed how markets seem to be expecting central bankers to respond to coronavirus concerns with some sort of stimulus, but it's not just central bankers. OPEC's going to be in focus this week as well, as they're set to meet and expected to cut as well. I'm hearing as much as 1 million barrels per day right now, up from 600,000 just a couple weeks ago.
Yeah, what a fluid situation. And just yesterday, Russia finally announced that they will go along with some sort of cut. We don't know what that cut is, but that had been a little bit of a question mark over the last 2 or 3 weeks or so. So we do expect that to come out later this week. In theory, it's going to be a good thing for OPEC. It should support oil prices. In reality, though, the bottom line is it still comes down to basic economics, Ben, supply and demand. So, yes, the supply is going to be choked off a little bit more, but the demand has probably been choked off that much greater.
Yeah.
At some point, there will be an equilibrium. We don't know, if that point is maybe 41 or 38 or maybe 52 in crude, right? We don't know what that is, but at least that uncertainty that's been weighing over the crude market for the last couple weeks of will they or won't they seems to be behind us now.
Yeah, overnight down to 43.32. We're showing the chart right now. We're, a couple dollars off that low right now. 45.41. We're up by about 1.5%. Scott, crude back to levels we haven't seen since the end of 2018. While the ES has pulled back some, still holding up around September levels. Is crude telling us, like it did in the sell-off that we saw at the end of 2018, that there's more to come to the downside in terms of indices in this correction?
I think if anything, Ben, when you look at comparisons between what's going on now in the equity versus commodity space, we're seeing trends, we're seeing trade like we have not really seen in the past before. So I think you have to take this whole data set, these correlations we're looking at right now, and really take them with a grain of salt, because we're certainly in a time that, I've been doing this 30 years, you've been doing this a really, really long time. And this is one of those outliers.
Yeah.
This is the way that the correlations are trading between the equities, commodities, fixed income markets is very, very, it's interesting to say the least, because it's not following historical patterns.
Yeah, we've talked about black swan events in the past. This is more under the category of something along the lines of a neon swan event. We were just talking about OPEC cutting. Earlier in the show, we were talking about the Fed cutting and how, in theory, this could ease investor sentiment some. But in theory then as well, Scott, you could argue that OPEC cutting and the Fed cutting could spark some more concerns in terms of the kind of mindset. What do they know that we don't know?
Well, at this point, unfortunately, I'd say they don't know anything that we don't know.
Because no one knows anything.
No, exactly. They're being reactive, not proactive. In my book, and that's not a good thing. That is really not a good thing. And the bottom line is, I've been saying this since last week when all the news about central bankers coming together and making cuts came about. What's the difference, Ben, if you or I have 1.5 or 1% 10-year interest rates? If you are, or I am scared, and I'm not, but I'm just saying, if people are scared of going to the mall, going to a movie, going out to dinner,
doesn't matter how much you cut.
It's irrelevant. It's irrelevant. Now, the flip side of that can be said is, okay, for now it doesn't, but 3 months down the road, 6 months down the road, you may get it back on the back end because, all right, more refinancings, all that sort of stuff.
Yeah, so it's not just the Fed, it's not just OPEC, it's not just us as traders. We're all in a bit of a wait-and-see mode, it sounds like. It's interesting because we were just talking about the impact that, the correlation, I should say, that crude has with the indices. Certainly we saw that into the end of 2018, beginning of 2019. But we also have a bit of a correlation between crude and rates, the TNX. We were just talking about rates coming off to levels that we've seen. Crude and the TNX oftentimes, they can track each other very closely, as both tend to be good economic, barometric kind of indicators.
Right. Yeah, no doubt about it. But I think what you are seeing now, and this was, in my opinion, the phenomenon we saw last week with gold, is Gold didn't rally last week as the safe haven, even though it had ran up as it should have, because people were taking profits to buy the bond market.
Noted.
You know, I know a lot of analysts are saying people were selling gold last week because they had to make margin calls elsewhere, which could be as well. To me, they were selling gold, taking profits, and buying the bond market.
Yeah. You know, what's been interesting is while crude's been coming off, gold, you mentioned a minute ago, copper has been relatively sideways, but still near multi-year lows. I guess it's somewhat encouraging to see copper at least not into new lows. We're actually looking at gold on the move higher and how it's coincided with the VIX spike. But even amidst all this, interestingly enough, for the most part, copper's been holding in there.
It has been, and it's hanging by a thread. It really is if you look at the charts, but it has been hanging in there, and I think there's hope, you know, that what's going on in China right now is subsiding. And if it is, okay, then that gives me hope, and that should give everybody else hope that to face this virus, it's going to be tough. It's going to be difficult. There's going to be a lot of pain. But if it really is subsiding this quickly, and it's a big, big if, Ben, it's a big if, because we just don't know if we can trust all of these metrics coming out of China, then that is a good thing. And that's perhaps why copper is just not completely imploding.
Yeah. Scott, let's talk a little bit about what you're going to be dialed in on this week. We've been covering some of the economic data, some of the PMI numbers, the ISM data that we're going to see this week, the jobs data on Friday. I'd imagine you'll be keeping an eye on any headline news associated with the spread or lack thereof in terms of coronavirus, the Fed. What else do you have your eye on this week?
You know, my biggest thing actually is to look at the numbers when they come out and take them all with a grain of salt, as everyone should do. I don't think we're going to get big knee-jerk reactions because everyone's going to believe, or they should believe, that this happened because there's a reason here. And like I just said a couple minutes ago, to me, the factory numbers that came out over China over the weekend don't concern me as much as they concern other people, because if the flow of this virus, if the spread of this virus really is kind of just ebbing a little bit in China, and again, big if, we don't know if those numbers are correct or not, those factory numbers, the PMI, the economic numbers are going to pick up real quickly there, which to me is a very good sign.
Scott, last but not least, I just wanted to get your thoughts in terms of what this all means for the U.S. dollar, because oftentimes we see activity like this, we start to think about that flight to safety, the safe haven type tendencies that you see with the U.S. dollar. Interestingly enough, though, the dollar's been coming off quite a bit. I'm wondering if that's more tied to the impact that these historical low rates are having on the dollar, and if it's finally starting to take notice, because we've touched on it for, well, years now in terms of the disconnect that the dollar's seen as far as its correlation with rates here in the U.S.
Yeah, there's no doubt about it. It's absolutely correlated to the 1% rates, or nearly, that we're seeing right now. Some of the weakness, and you know what? I think that the dollar has made a preemptive move on a little bit of a sell-off here to what the Fed and other central bankers are going to do.
Noted. We're seeing a little bit of an increase in terms of the euro currency, which has been getting a bit of a lift, which, you know, interestingly enough, they had some numbers out overnight. German manufacturing, EU and UK manufacturing PMI were a little bit better than expected for the most part, and above last month's readings as well. Now, again, as you mentioned, take that with a grain of salt, but Scott, we'll continue to watch the numbers, headlines, and market reaction too. Really appreciate you giving us part of your Monday morning and starting the week with us here on the network. Traders, that's Scott Bauer. He's the CEO of Prosper Trading Academy.